Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, often referred to as Sir Ryan Isaac, and I'm here with Matt Mountain Molcock. What's up, Matt?
Wow. That was like introing me for like a sporting event.
In my next career, I am going to go for what's the third junior in NHL league? I'm going to be an announcer in a hockey ring in the third lowest tier.
I don't even know what that would be.
I'm just guessing. I don't even know. I just want to drive a Zamboni.
Like AAA baseball, but for hockey.
But lower, and for hockey.
But lower.
But lower. And I know nothing about hockey either.
You'd kill it. You'd do great.
I would. Matt, in the interest of making our marketing team happy and our audience too, we're going to get right into this. What are we doing today? This is a cool thing, I think. I'm excited for this.
We have decided, we realized we've been doing this for almost 10 years, the podcast, and built a ton of content. And we thought, well, why don't we go back and start refreshing some of the podcasts and revisiting some of the topics that we hit and seeing what has held true, what are still beliefs that we have, what are things that need to be changed. And so we've started doing this. I'm calling this out of nowhere, just from the hip.
Marketing loves when we do this, by the way.
The refresh series. We're going to call this the podcast refresh series.
Ooh, remix.
Remix. Oh, there you go. That's even better.
Remix. Yeah.
Remix. The remix series.
Yeah.
So we went back. We have a list. I pulled 80 plus shows, and we're just kind of going through and rebuilding outlines. And this episode we're going to talk about today about money myths was the second ever podcast topic that you and Reese hit 10 years ago.
Yeah. And shout out to Justin. We used to call him Q in the studio. And I don't remember where Q comes from other than maybe it was the James
question.
Bond. Well, it's question.
It stood for question guy.
You're right, because there's Q in the James Bond series is sidekick, helper, but it was question. Yeah, Q in the studio, and Justin would sit in the corner. Everything was scripted, even if you want to call them jokes. Our jokes were scripted.
Everyone's like, yeah, we could tell.
It's so bad. And then he would hold up an iPad with a timer running, and we would. I think we stuck to if you can believe this, 25 minutes. We actually were hitting 25-minute episodes.
People were like, "Could you get back to that, please? That'd be wonderful."
Honestly, maybe. And so, shout out to Justin. He used to sit in the corner queue with we had our script. I mean, imagine reading a script with Reese Harper. Can we just give a little reverence for what that was like?
Yeah.
It was amazing.
Incredible.
I'd be looking at my lines, and then I'd say it, and I'd look at his next, and I'm like, that's not your line.
Yeah. It's what are you...
wait, hold on.
We're going off script?
That's where it's shocking. It was so good. So good.
So funny.
All right. Well, so these are the top, how many? The top...
We're going to talk about 6 money myths.
6 money myths.
Dentists still believe.
And so this was from 2015 when we put this together, then, is what you're saying.
I made a couple of edits.
Okay. Yeah. Yep. And this is a test. Do we still believe this stuff? Yeah. I really like this, because we do reserve the right to change our minds at any given point.
Yeah, of course. We were always reserve that right.
Yeah, don't hold us accountable for anything.
Even in the middle of the show, we do.
In the middle of a sentence.
Yeah. Middle of a sentence, I might.
Yeah. Well, let's get into it. Well, hold on. Yeah, well, let's get into this part. You wrote some cool ones. Were these from the original? Some of these fun, kind of interesting...
I added a couple. But yeah, some of these fun myths were right from the transcript that you guys talked about.
Okay. Hit them.
I'm just for you. I added one just for you.
I see it. Go.
You see that? Okay. So here's the first one. Some fun myths that
I still believe this first one.
I still believe this for sure. That gum stays in your stomach for up to 7 years if you swallow it.
I was just on an airplane, and I'm like, I want to eat this cookie, and I'm like, where do I put my gum? I don't have anywhere convenient to put it. And I'm like, I'm not going to swallow it. This thing's going to be in my stomach for 7 years.
It's funny how things that you're told when as a kid. I remember being told this at elementary school, and I was like, oh crap, I've swallowed a lot of gum in my life.
Where
does it go?
Why do you think parents and or teachers or adults didn't want us swallowing gum?
I mean,
did they believe? They probably believed it.
I think they probably just believed overall
it would make us sick.
It's not good for you to swallow something that doesn't break down in your mouth.
As a parent, you don't want a little kid with a tummy ache. I mean, that's just disaster. It's going to ruin your day.
We talked about this, Ryan, right? So how crazy is it growing up in the era that we grew up in, pre-social media, pre-internet,
Yeah, I know where you're going with this.
pre-phones. Like I
I know where you're
remember
going
the
with this.
days of no phones, right? Like meaning no cell phones. How in the world did things cross like
Across the
countries,
country,
across the world,
generations. How?
generations of like, very specific. We're not going to reference them today, but they're very specific rumors that would go around about like celebrities and famous people. Like that was just a big worldwide game of telephone.
How did it get from third grade in Jim Bridger Elementary in West Jordan, Utah, where I attended,
to Roslyn Heights in Salt Lake City,
and then across to Rhode Island and down into Florida and Kentucky, and the rumors got around. I don't know. Okay, so the gum,
the rumors. Okay,
the gum's not. So it's not true. I mean,
not true. I think they digest the same as anything else. So gum.
It's like funny because I don't believe you.
Like I'm gonna look at this. Okay, next one. This one hurts. I'm sorry. I added this one.
No,
I
like
added this one for you. Shaving makes your hair grow back thicker.
So is this not true?
Not true. It's not true. So sorry.
I mean, I'm the best experiment. I've been shaving my head for literally 20 years, and if that were true, I would be the best.
You'd have the
I would be the case study.
Ever. Yeah.
I would have Italian soccer player hair.
Yeah.
I would. I'd literally have Italian. You know when they like tie it back with a shoelace? Like it's so cool. Yeah. No,
you're like, I'm not jealous at all.
This doesn't work.
Okay. Next myth: you lose 80% of your heat through your head. That is apparently not true. I don't know where you lose it. I think just your whole body, but you do not. You do not lose it through your head. 80%.
Again, moms are just trying to get us to put on hats in the wintertime. Like
these are what our friend Carl Richards would say are righteous tricks. They're trying. We're just trying to, especially the gum one, and then this one is just parents doing their best to trick their kids into doing what they should be doing anyway.
I'm going to throw another one on here in a minute. Well, I'll just do it right now. And this might actually be true. My mom used to tell me that if I messed with bees, they like had this signal where they'd send the whole hive to come get you if you messed with one. You too?
Yes.
Okay, hold on. We're pulling up Chatty G. Hey, Chat, is it true or is it a myth that if you mess with one bee, there's a signal that goes out to the whole hive and they'll come get you? Was that a childhood myth from the 80s? All right, let's see what Chatty G says.
We're going to see what it says.
Okay, Chatty G says it's thinking. It's you too? The bee myth?
Yeah, go ahead. So what does it say?
Oh, you're talking about the old beehive revenge signal myth. This is one of those things that started as a kid's story. It does release pheromones when they sting to attract nearby bees. There's no radio-like signal where it came from. It's a myth. They do release a chemical alarm signal when they sting, which can make nearby bees defensive, but not an alert for an attack. It can make nearby bees defensive. A little bit of a truth there. Moms just didn't want to stung.
So I was told that if you killed or hurt a bee or messed with it, same thing, it would send a message out and the more would come. I was absolutely told this.
I still believe it.
Yeah. In fact, truth be told, no joke. I was at the park with my kids the other day. Bee was messing with me and I had a hat on like I do now. And I took my hat off and I smacked it, hit to the ground and I killed it.
And then you start looking over your shoulder.
And well, yes. And then I was like, oh man, are other bees going to start coming after me? So yeah. Totally believe that one.
Okay, all right, one more.
Last one, this one I for sure believed.
Okay.
And still kind of do. You have to wait 30 minutes to swim after eating or you'll cramp and drown. Again, moms just keeping the kids safe.
Moms keeping it safe. I eat so many calories before I go out and surf because I'm going to be hungry and cold.
Yeah, of course.
So,
yeah.
All right.
These are all myths.
These are all myths. The point being, clearly, even averagely intelligent adults, averagely educated adults, such as, I'll just say me.
Is that what we're calling us, average?
I
appreciate that. Thank you.
That's generous.
I appreciate that, yeah.
We carry myths with us in all kinds of scenarios, like ridiculous, unimportant, we just do. We pick them up from culture, how we're raised, what society, whatever. We carry them with us. It is no different when it comes to money and finance. And almost it's worse. To be honest.
It is worse. Consequences are higher.
They're higher, and we all of us do it. We have like money myths that we carry, and we carry them around, and then we behave accordingly to our own detriment quite often, and we don't even know.
Yeah,
that's the whole point.
If you think about these myths that we just highlighted, they're fun. They're just kind of like, they're from our childhood. The gum in your stomach, your hair will grow back thicker if you shave, like 30 minutes after swimming type of thing. Like these are all just kind of fun, inconsequential, very low risk, low consequence myths. They're harmless.
Yep.
And they're just kind of fun growing up, being like, yeah, I believed that too. I believed that bees would come attack me if,
Yeah.
if I stepped on one. So,
Yes.
but what we're going to talk about today, to your point, Ryan, is these are more dangerous. Like
Yeah.
the money myths that we carry with us and that we hear dentists carry with them, the misunderstandings around these things have like really, really significant consequences
Mm-hmm.
and can really hold you back from the ultimate goal, which is how do we make work optional as soon as possible? And a lot of times these myths that we carry can be really, really detrimental to that plan.
I totally agree. And also, I like that this is in here. I don't know if this was from before. Maybe it was. This is Justin. We just used to have really good outlines. We have a fix. We have a myth,
Yeah.
points of the myth, and a fix for each myth.
Fixing all of them.
A myth and a fix, as they
Myth
say.
and a fix.
What is myth one?
Money myth number one that dentists still believe the stock market is a casino or the stock market is rigged. What say ye?
How often do you hear that?
I hear some iteration of that or implication that is
Quite
made
often.
around that quite often. And just a general overall fear of the stock market still very much prevails.
Yeah.
Although, let's talk about this for a second, Ryan. What has changed since you guys recorded this exact topic 10 years ago? The rise of crypto and these other assets like this have, I think, and I want to ask you, I feel like there is still fear around the stock market, no question. But I also feel like there's this kind of, especially with the younger crowd, of like the stock market's like boring kind of unk stuff. Like that's what, that's what like you old curmudgeon guys are into. We're into the new age stuff. I think that's actually a pretty new concept.
It's changing. I love that we're revisiting. Your idea was genius. It's all your idea. Great job. Revisiting this stuff is going to be so much fun because it has changed. In 2015 when we recorded this, it was a ways after the financial collapse of '08, but the after effects of '08 lasted into the 2010s easily. And there were so many stories of retirees at that time whose retirement blew up because of the stock market crash. But that wasn't because stock markets crashed and never recovered. It was because they were overly concentrated in too few assets.
Yep, exactly.
Which made them end up perpetuating this story and this myth that the stock market is a total crapshoot. It's a complete casino and it's a total gamble. It used to be more prevalent as some of those people are exiting the market, and the voices and the places we get information is changing too. That's probably the biggest part. We don't, as a society, unless you're over a certain age, we don't turn on CNBC like we used to. It's like everything's coming from TikTok.
It's so true. Social media. Yeah.
Yeah. So the idea is the way the information is delivered. I think you're right. I think the stock market is almost deemed boring, not fast enough, and
returns aren't big enough.
They're not big enough.
Yep.
And these new asset classes have replaced some of that. So it's an interesting myth. It does exist. I do hear this still often, but it's different than it used to be. So interesting.
I think it is different, but it is still very much approached with a misunderstanding of what it is either way, whether you're on the side of it's boring and not fast paced enough, or it's just rigged. It's just a casino. I think I've shared this before. I grew up on this myth in my own life. My whole life. My dad's a real estate guy, built everything he's done wealth wise, pretty much in real estate. And so growing up, I remember as a kid, he would tell me the stock market's rigged or the stock market's just gambling. And I came to find out later as I got into what I am in now, after multiple conversations with him over the years, that he was carrying with him a specific experience of taking some money that he had earned through other things and put it into a few penny stocks that ended up blowing up. And I'm like, and it's just interesting hearing that, and how many times I think about how many times dentists are out there just going like, where these myths come from matter, right? Digging into where they come from actually matter. And why do you believe that the stock market is a casino? Most of the time is going to come from either your own personal experience or someone that like your parents or someone told you.
Yep. Totally, man. Yeah, and again, we carry these things for a variety of reasons, but they stick with us. Let's go some really good points here. Let's go through some of these. Why I guess this myth exists, or like what are the discrepancy? One of them is that owning companies, and this is again interesting. Owning companies in the stock market it's not the same as, it's not gambling.
No,
that's not what that is. Owning, now we say this later, owning one company with too much of your wealth or too big of a share of your net worth, that is a gamble. That's a different kind of gamble. Owning a company is not gambling. Explain that. What does that mean?
Yeah, so I think this is the fundamental aspect of where people misunderstand what the market is. Uh, and I think it's important as we talk about this is the distinction between investing and trading, right? If you're going to treat like there is definitely a possibility of you treating the stock market like a casino if
Mm-hmm.
you're going to be trading. Everything we talk about is investing, which comes down to what you're saying, which is
Yeah.
like at its core, when you buy shares in something or when you put money into the stock market as this general term, like
Mm-hmm.
what are you actually doing? Well, you're buying actual shares. You are becoming a co-owner in a business. Like I think people, although that sounds obvious when we talk about it, I don't
It
know if
doesn't.
that's how
Yeah.
people act or
Yeah.
they don't think about it like
It's
that.
not clonking to you.
Yeah,
Yeah,
exactly.
yeah, it's not. Yeah, people don't think of. You're right. People don't really attribute it to actually owning a real life asset that you have a real claim to. I don't blame people for thinking that because it does feel very removed and it's digital now. Now it's everything's digital and everything's transactional digitally. But
Yeah.
yeah,
Well,
that makes sense.
if you think about it, it's actually the exact opposite when we talk about investing is the whole point of investing is setting yourself up for what we would call expected returns, right? Positive expected returns.
Yeah,
It's all just
uh-huh.
about a matter of playing probabilities. But when you talk about gambling always has a net negative
That's what's interesting.
rate of return, right?
Yeah,
Or
that's what's
expected return.
expected return. I mean, every game, every casino game. We did this on another episode too, where I listed all
The
of the probabilities
probabilities.
of every game. Yeah,
Yep.
all of them have an expected return over time favoring the
For you to
house.
lose.
Clearly,
Yes.
I mean,
Yep.
we all know this, but still
The
engage.
market's the exact opposite.
It's literally the opposite. Now, any one single given company, maybe not,
Sure.
just because of how long companies survive and do and don't go out of business. But again, we'll hit this in the fix. But the market, especially as a whole, is the complete opposite. And do you have any of these stats off the top of your head, or maybe just close to like any given 10-year period of time in the history of the market, or 12 or 15 or 20-year period, rolling period? Do you have any of those stats top, like
Yeah.
close?
So I can give us a general range. I don't have
Yeah.
them exactly in front of me, but um, on any given day in the stock market, so let's
Oh,
just
yeah.
use the S&P as an example, is where we
Yeah.
have
Yeah.
most of the data.
Yeah.
On any given day, it's 65 to 70% chance it's going to be a
Okay.
positive day.
Yeah.
So the odds already are in your favor.
Yeah.
You go out to 5 years, it turns into something like 85%. You go out to 10 years, it's 95%.
Yeah.
There's never been a 12-year
12. Yeah.
rolling average of net negative returns in the S&P 500 ever.
Yeah. Ever.
20 years
Ever.
beyond, it's something in the, I think at 30 years, if I remember correctly, at 30 years, the lowest ever average rate of return, any rolling 30-year period, is 8%.
Yeah.
The highest is 14.
Which put your money in, put a normal amount of money in at a 8% average return for 30 years and see what the compounding looks like on the
Yep.
it's
Insane.
astronomical. It
Yeah.
is actually insane.
Yeah.
And it's worth, that seems like a long period of time. That's a long period of time to hold money. I get it. But also the actual investing life of the typical dentist starts in their 30s and will last into your 80s or beyond, or generations beyond. So you have a half a century investing time frame. It looks different, times when you're adding and taking away and times when there's no more income. Yes, but I mean, you've got 50, 60 years of investing time ahead of you. So these stats absolutely matter, and they're the complete opposite from a casino. I'm glad you said that. That's really
I think I wrote an article about this, I believe, and I think we did a show on this, which we said it's actually interesting because we talked about how I think the title of the article was something like investing is gambling and you are the house. Meaning, like
Yep.
when you look at those numbers, it actually is gambling. Sure, we'll call it that, but you're
Yeah.
the house.
Yeah.
If you do it right, you're actually putting the odds in your favor.
Yeah, and
If
you
do
are the
this
house.
right way, you are the house.
Yeah, it's so cool.
It's kind of like trying to reverse that mindset.
That's exactly what happens. Do you want to talk about how some of this myth is perpetuated because people equate the price of a stock with the value of a stock? Kind of goes hand in hand with, like, you own a company.
Yeah.
You have actual claims. The price is not the value. What does that mean?
Yeah, no, it's not. Again, if you talk about price, it's like the price is what is the kind of outward thing that you were always seeing and hearing about, right? But it has
Yeah.
nothing to do with the underlying value of the company, the actual company itself that you own. Let's take Apple, for example. You own Apple in your portfolio, let's say, and my guess is if you have any assets in
You
the
do.
stock market,
You own
you
Apple.
own Apple.
Yeah,
Like
yeah, you own Apple.
the value that you actually own as being a co-owner of that is the operations and the value, like the what Apple is actually doing in its business and its actual operations. It's got thousands and thousands of employees. It's building products. It's adding value back to the world. Like the price itself is going to go up and down in the short term. That doesn't mean it's the actual value of the business that you have over time.
Yeah, and over time. And when you think about it in terms, you put this in here too, when you think about it in terms of other assets where this plays out more logically, let's say a piece of real estate or the dental practice that you own, not you, Matt, the people listening, of course,
I wish.
You know that the daily value of those things fluctuates based on, did your roof just leak? Was there a flood in your office? Did your main office manager that held everything together for 20 years just quit on you? The value can fluctuate any given day, but there's no market pricing it 24/7 like the stock market. And in your head, you're like, well, collections went down, or we shut down because there was a flood in the office. And I know that practice is worth less this month because collections went down, but over time, I'm not worried about it. That's the same in the stock market. It's just easier to get in and out of, so we don't really treat it that way. But
it's so true. It's a great point. And I think why we've talked about this in the past as well, that the transparency of the stock market, of its pricing, is a gift and a curse.
Yeah, it's one of the risks of investing in stocks is that you have to deal with a liquid, transparent market, which it's a benefit. FYI, it's a huge benefit.
Huge benefit,
but it's different and you do have to deal with it.
But it magnifies the risk of behavioral missteps, right? So because you talk about, like, you just use private business, a practice, or let's say real estate, the stock market as an asset class is better than real estate. I'm saying, yeah. I'm putting my flag in the ground, and I will continue to do that.
Dude, they're coming for you. That's Matt. That's Matt Molcock. He lives in Salt Lake City, Utah.
Come at me. That's okay. The stock market equities as a whole are more passive, dare I say, than real estate.
Yeah.
Better returns overall.
Yes. Statistically,
right? Statistically, smaller lower barrier to entry, much easier to diversify. Like pretty much everything across the board, liquidity, transparency, all these things. Yeah. Equities are a better asset class than real estate. That's to me, that's just an easy fact.
Statistically, is it as fun? No. Does it feel as nice or as special? No. Is it as interesting? Probably not.
Yeah. No. But here's what I'll say: real estate will, if you're able to get into it, and a lot of dentists can, because you talk about barrier to entry, you have a lot of cash income. What happens with real estate, and I will give real estate the plug here for sure, is once you're in it, you're in the confines of how difficult it is to transact in it. Meaning the more friction there is in that transaction. So if something goes wrong, it's like, well, I can't just push a button and sell my building.
Yeah, because you would, by the way. If there was a button on your iPhone to get rid of that freaking building every time something broke or went wrong or a tenant left or like the root, we all would. We'd be push, I'm a renter now. Screw this.
Exactly.
Oh, yeah. Yeah.
So because of that, real estate does get a nod on the behavioral side because of the obstacles that are in that way. But equities are a better asset class.
How is someone, I mean, I know the answer to this, but really, like, there's some smart people. How is someone not come up with a market to like sell shares, fractional shares of real estate that you own at the push of a button when you're bored of it? Like,
I think there's platforms that are doing that.
That's gotta be. I mean, there's just too much. Like, you know what I mean? Like, you own a house and you're like, you know what? Not feeling it this year. I would like to raise a little cash and offload a little burden.
Yeah, it's really tough because of
it's lending.
It's lending, liquidity.
It's liens, it's ownership, it's lending. That's why. It's because most real estate is leveraged, and so that's too big of a burden. I answered my own question. I already knew. Okay. Should we do the second myth? Do you think?
We should get to the fix. Let's hit the fix, and we're gonna have to speed this up, Ryan.
They don't want a part 2, right?
This is what we do.
3 and 3.
We could. Should we? Should we just Should we just do this?
I mean, if we're not wasting time. This isn't banter. It's not me and you trying to laugh about, Gen Z
Sometimes
slang.
it is. Yeah.
I mean, we're having a good time.
We could do 3 and 3.
Let's go 3 and 3. Watch us.
3 and 3. Hey, watch us. We'll go 3 and 3. All right. The fix to myth number 1 is so diversifying, right? So you have to diversify. That's the foundational fundamental piece of a portfolio. Well, and I'll say there's actually a couple others. Asset allocation, right? So the mix of assets you have,
Yeah.
diversification. So how
Yeah.
well, like you said it earlier perfectly, there's a huge difference in owning one specific company
Totally.
that
Yeah.
provides all of the risks of that one company screwing up and going to zero is very
Yep.
possible.
Yep.
We've seen this with long-standing companies. Think
Oh,
like
yeah.
GE.
Out of nowhere.
Out
Something
of
comes
nowhere.
out of
Kodak.
nowhere. The government decides to like not like this company anymore for any given reason. This happened all over the place for decades. And then all of a sudden they lose contracts, they lose funding, they lose regulation, things that prop them up. I mean, things can come out of absolutely nowhere. So totally. Yep.
So diversification, rebalancing strategy, right, is key there.
Yep.
And so having those fundamental aspects of a portfolio is the fix to removing the casino-like aspect of it, or flipping it on its head and you becoming the house, right?
Yeah.
And then the other parts I'd say here would be following what we would call an IPS or an investment policy statement. So it's basically just saying having a strategy that fits within your overall plan, and then actually giving it time and contributing to your accounts on a regular basis.
That's the fix.
Giving it time.
Like you were saying earlier, that any given 30-year period or even 12-year period is just, just going back really fast. The fix of diversification, though, this is what's really interesting, is it still takes some precision and strategy to diversify a portfolio the right way, because it's not just a lot of stocks. It's the type of stocks, and it's where they're located, and it's the right balance of those things, because you can still, without really knowing, you can still gamble even when you think you're diversifying. For example, the average American's portfolio is way overly tilted to US stocks. They don't think it's diversified, and it's better than one stock by a long shot for sure, but you can still be missing the mark a little bit even when you feel like you're diversified. So there is, this takes some thought, this takes some process, this usually takes someone who knows what they're doing. But that is absolutely the fix. That's how you get it. And it's not hard to do. It's like you said earlier, it's the easiest asset class in the world, not even close to be diversified in. It's
100%.
So easy. Yeah, so easy.
100%. And to get access to returns from all over the world.
Yep.
Right. So that's a huge part of it. Okay. Myth number two. You want to hit this one?
Yeah. 30 minutes in. Let's go. Myth number 2 out of 6, as if we're going to hit 6 today. Come on. But you can time the market. Yeah. Okay. So this one still is completely prevalent.
100%.
Completely in society. And
alive and well.
It's alive and well. And I was going to say maybe more than ever, but probably not more than ever. The market timing was the birth of the stock market in the first place. The only way to have access to stocks, not even that long ago relatively, was calling a broker, someone who's physically standing in a stock exchange and getting sold something based on some kind of timing aspect. I mean, market timing was the way to invest forever, and a lot of people still do it. Having said that, it's as prevalent as ever, and it could be more so just because of the way we consume information. What do you think about that? Is it still, it's common, yes, but is it like more common than ever that people feel like you can time the market? Or is it generational?
No, I think this is actually worse than ever before.
Okay.
That people think. I just think I think you gave a great example of it. Used to be the access to the market and your ability to attempt to time things was through a broker, right? Like we're talking back in like the 80s.
Yeah.
And even in the 90s, like discount brokers, they call them, like retail brokers, really started to become prevalent with the age of the internet, like in the 90s, right?
Yep.
So prior to that, yes, it was like the only way you did it is if your broker called you up and was trying to sell you on something, right? And making a big fat commission. Now
a BFC, as they call it,
big fat commission.
It's like the BFG, but it's the BFC.
ABCs, baby, always be closing.
Always be closing.
But now I kind of look at it as like, just like everyone thinks they're a journalist because they have a phone, right? Everyone now thinks, or a reality TV star because they can post them whatever their opinion is on the dumbest crap ever. But same thing with this is like now everyone thinks like I think the access is what makes it worse than ever. The accessibility to click a button right on your phone because you saw something on TikTok 2 seconds before. I think it's probably worse than ever before.
And the spotlight, the social media shines on the rare anomalies of like guessing and stock picking, like the meme stocks on Reddit,
Yeah, the
it's just
stories. Yeah.
the stories. I mean, we're talking, 2 or 3 stocks over the last couple of years that have just done astronomical, crazy, weird things. And then randos, made a ton of money without any process or skill, or it's just pure luck or whatever. Those things are amplified so much that, it's just the story seems it's more accessible. It's
so
everywhere.
true.
Yeah,
It's
yeah,
so
yeah.
true, which leads into our bias of thinking it's like you said, it's more prevalent than it actually is. Like you hear a lot more about the winners through the platforms of social media for sure.
Yeah, totally. Okay, so a couple of things here when we're talking about timing. I mean, these are things where these are time tested principles. We're always talking to clients about this. These are some of the things that our own investment philosophy is based on, which is not market timing. Talk about timing requires 2 perfect guesses, getting out of something and then getting back into something. Talk about those 2. They are very different, very different feelings, totally different sense of momentum,
Yep.
and a completely different mindset that you have to be in to do each one of those.
Yeah. I'll, I'll just say on this one, if you just don't do it. Like if you
So
think you can do,
let's
like,
save some time. Yeah.
no, I'm just saying, if you think you can do this, like there is so much unequivocal, there's mountains of data
Hmm.
that will tell you you cannot do this.
Yeah, yeah.
You
It's
will
all
not.
the data. It's
It's
all the data.
all the data
It's all the
that
data.
will.
And yeah, it's all the data. And it's the data coming from the tippy top tip the spear pinnacle of the mountain in our industry, like the big hedge funds. Their own data shows year after year after year, they don't do it either.
Yeah. No, they don't.
They don't beat basic indexes either, the
No,
majority of their industry, and not over time at
it's
all
something like
whatsoever.
85+% of professional money managers who manage mutual funds do not even beat the S&P
Every
500.
year.
Don't even beat their benchmark. And one thing I'll say on this is that's how it should be. Like it should be really, really hard,
Yes.
right? It should
Yes.
be. Like
That's such a good point. That's such a good point.
it
It
should
should be
be
that way.
really hard to play in
Yeah.
the NBA. Like
Yeah.
it
Yeah.
should be really, really hard to be a quarterback in the NFL. Like
Yeah. Uh-huh.
that's exactly what we're talking about is like the odds
And
of you
the rewards should be out of control.
astronomical.
Yeah, they should.
They should be.
Yeah.
But I'm sorry if you are ortho with 2 locations, running a practice, managing a team, and HR and marketing, and doing your like
And a whole life and everything.
and a
Yep.
whole life. You've got kids, you've got hobbies. You're doing like
Yeah.
you are not going to beat the top 1.1 point or 0.11% of people who are actually maybe timing things.
Yeah, the literal PhDs who work 80 hours a week on one company's financials to like, yeah, I mean, it's not going to happen. That's such a good point. I am always the conversations. I actually kind of enjoy them. They're good learning lessons, and I'll just speak to one recently. Well, it was earlier this year, and you and Jake called this. Remember earlier this year, the tariff stuff and the market is going down, and
Yeah.
a lot of stuff going on. And what did you and Jake say? No, we're gonna end it. We're gonna end it positive. You're like,
Well, yeah, it was at the lowest. It was like down 20% in April, and Jake
after
and
like
I
10 days.
Jake and I were like, "Oh, this doesn't seem like it's
Not
going to
gonna-
hold." And
not gonna hold.
Jake and I called on the podcast. We hope it holds true that we'd see double-digit returns this year.
Oh, that was it. Okay,
Yeah.
I love it. I love it. I'd like a lot of our advisors probably had a handful of conversations with clients, especially clients with bigger account balances, maybe older clients at that time. It's always interesting to revisit that mindset of what it feels like. Okay, this is what I was getting at. The urge to sell and get out of something is always built on the momentum and like the things you're feeling, the energy of the news. That's what it's always built on, and it's always fear. Of course, it's always fear.
Always.
It's understandable, completely understandable. I get it, and that signal feels like a no brainer in the moment. It feels like a no brainer. In hindsight, it definitely was not. It always feels like a no brainer, even if that were true, which is not. It's not a no brainer. Feels like things feel so obvious trying to get out of markets. Getting back into markets requires, and if you look at any period of time where markets bottomed and then you go to the day that it bottomed and then when it started its rise back up, the news and the sentiment and all of the energy of everything going on in the world and the markets at that time was still really bad.
Really bad. Doomsday.
Doomsday. So you have to it's weird to think that, the same environment that created your fear and your urgency to get out of something is still going to exist. And it might even be even worse because now you're at the bottom of a slide of a sell off. You now have to take that same energy and environment and you have to switch your entire thinking and all of your feelings and emotions and reactions and everything 180 degrees. And you have to do the opposite of what felt so obvious before, because now you have to get in somehow when the news is still horrible and the outlook is still bleak and things still aren't gonna there's nothing giving you hope. You have to flip a switch and get back in when it's still the same environment. That is a near impossible task for a human to pull off. And we know that computers can't either, obviously, still, because that's how the biggest traders are doing it, is with computers, and that's still not working either.
So true.
It's just a fascinating, like, psychological place to be in two different mentalities, incredible discipline that you have to pull off perfectly in the same negative, fearful environment. And it's
Yeah.
just so hard to do.
Well, and think what that entails to do that. Let's say you did it successfully. What that implies by you out there, like by you saying, yeah, I still think I can do it.
Yeah. Yeah.
What you are implying is that you know more than the collective of the entirety of the market, which all the supercomputers, all the PhDs, all the investors out there that dedicate their entire life to, like, all the people that are dedicating teams to doing this, that you are saying, again, by saying, no, I hear you, but I think I can still do this.
Mm-hmm.
You are literally claiming that you know more than the entirety of the market, which is just probability wise. If you just think about it that way, it's just not possible.
Yeah. It's not a shot.
It's not.
This isn't an insult. None of us.
No, I don't need. I'm not even. Hey, I'll say this, dentist. You're closer than me.
Way
probably.
Closer. Yeah, way closer than
so
me.
If you're going to say, like, where am I on the podium? I'm ahead of Matt.
Yeah. Now, well, we'll get there to the fix. I was going to say the good news of all this stuff. Is there anything else you want to say about the timing of two perfect decisions, or anything around that before we get to the fix, or and you put in the notes here the bias of hindsight, the benefit of hindsight, what that feels like.
I just think I like that we put this in here about the bias, the hindsight bias, and you said it earlier of, like, it always seems so obvious after the fact.
Totally.
And I think that's actually one of the problems. Is a couple things. Our brains are really good at tricking us, really good at tricking us. And we're really always good. All of us are really good at telling ourselves stories. And one of the stories we tell ourselves when it comes to big events or like market pullbacks or whatever is, oh man, I totally knew that was going to happen. And we actually believe it.
Yeah.
The other part of this is clout chasers out there that are leaning into telling you that, they love being negative. They love telling you, like, oh man, there's the conspiracy theories, or this next 0809 is going to be even worse. It's going to wipe out all the global equity. And I've heard it all.
Yeah.
And it literally, it's just clout chasers going for attention or trying to sell you a course.
Sell books and courses. What's so interesting about that, and we've been in this industry for a long time. It's so funny. There's people who build entire careers on constant negativity and doomsday, and they never get called out for. They don't stop. Like, they don't get canceled, and then, like, once out of every 15 years they're right for a minute, and then it's just like boom, book sales, like whatever course. It's so fascinating that they just keep doing it until they get it right. Like, after getting it wrong 100 times, then they, like, hit one. It's really fascinating, but it's in people's entire careers, journalists, writers,
or they
bloggers.
Never hit. And they just keep doing it, and people keep people are still listening to Robert Kiyosaki, like, blows my mind. The guy says the craziest stuff, and he wrote a book 30 years ago that people are like, that was a good book, though. It's like, but the guy has lost his mind, and no one ever calls him out. Everyone's like, anyway.
I'm not sure. Now this is the segment of the Dennis Money Show where we reflect on the state of humanity's consciousness and how well we take in information and research and data and make decisions based on that research and data and information.
Exactly.
We'll pause that we'll pause that segment.
We'll pause that part of the show and move on to the fix of myth number 2.
Let's give me my fix. What's the fix for timing the market, Matt, for all this stuff?
I'd say overall, we can get into kind of the details of this, but I would say the biggest thing is you have to have a system for investing. So you have to systematize this as much as you possibly can. And this is at the risk of sounding self-serving, doesn't have to be us, could be anyone, but having a high quality advisor team between you and that big mistake that can be massively consequential and like really detrimental to you, setting yourself back for years and if not decades.
Yeah.
One big mistake, one poor time, one click of that button
We all know
can,
that.
can offset your
Years.
years and decades of work. So having a system, having someone in between you and pushing that button is critical. I think part of that system is making sure you've got proper liquidity. We've talked about this a lot, is making sure that you've got enough liquidity in the business and you've got an emergency fund at home to kind of act as that margin of safety. So you're not freaking out being like, this is my life savings here going down 20%.
Yeah, totally. I'm reminded, I was just sending a copy of this, which is so cool that it still exists. One of our oldest pieces of content. It's you can get this on our website for free. It's an e-guide. Go to the dentistadvisors.com education library, e-guides. It's called The 7 Big Mistakes That Dentists Make That Wreck or Ruin Retirement. I probably should know since I just downloaded it.
I think it's wreck
retirement. These are just, everything you're saying are just some of the biggest things that just happen in over and over repeatedly in dentist financial investing picture. Holding too much cash, not doing that the right way, not proper allocation, assuming that you just set up some accounts and throw an S&P fund in there and then just like maybe a couple individual companies, and that's fine. Like, you have to build, I don't know, man. I wonder what you think about this. I love that our industry as a whole is building momentum and leaning towards like, hey, simplicity, long-term, low cost, diversified portfolios that hold for a long period of time with a healthy savings. I'm glad we're leaning more that way in our industry and generally speaking in financial education. I do sometimes think though that oversimplifies the job.
Totally.
You know what I mean?
Yep.
It's not as simple as opening one account, throwing random amounts of money in there whenever you feel like it into an S&P fund and then or a target date fund and be like, that's my retirement plan. It's still, people still frequently, I'm not trying to disparage, this is just what happens, mess up even simple diversification, or not enough rebalancing, or not paying attention to how you're way too conservative in that account, or you're way too aggressive at that point in your life, or you hold way too much cash. There's still some strategy and some stuff that has to happen, even building a low-cost, diversified portfolio that's rebalanced frequently and saved into frequently. But that is the fix. So finding a partner to do that well with and stay on top of it, maintain it well, that is the fix to the timing on this stuff. Yeah.
I'm glad you said that, Ryan, because we just did this. We do this for quite a bit, where dentist, really large portfolio, we're in talks. We're discussing them coming on board with dentist advisors. And so we go through, part of the process a lot of times, especially in these cases where they have quite a large portfolio that they want to bring over to us to have us manage. We do kind of some pre-work and say, well, we'll do a comparative analysis and see kind of how you're invested and what we would do different possibly, and just kind of give you a breakdown. And to that exact point you just mentioned of even basics of diversification, this was a professional money manager that we just did a review.
Yeah.
I'm not going to name names.
Yeah.
But a professional money manager, we reviewed it with Robbie, and we just talked this morning, and he's like, ooh, this is not great. Like they're just fundamentally from a diversification standpoint, he pointed out 3 or 4 different things. He's like, I would tell them this. Just go tell them this, regardless of whether or not they're going to just go do it, or go tell your guy to go fix this. Because these are some really, really big problems that it's very obvious what has happened in their case, which was a set it and forget it type strategy. And to your point, I think sometimes we do a disservice of saying low cost index funds, like that's all it takes. It takes active work, even if it's not actively
traded. Yeah, there's this in between where no, don't day trade in time markets. But the answer to that is not simply like chucking a target date fund into something and then just leaving it forever, or randomly putting money into it and never. There's still work to be done. It's not the work it's not the sexy work of like 10 screens and yelling stock orders back and forth on the phone, which does sound fun. I mean, just once in my life.
Yeah.
There is an in-between land in there that it's crucial to get right, because again, a common mistake is building a portfolio that you think is diversified, or you think will be the type of portfolio that can last through market fluctuations, and then it turns out that it's not. And you've gone 10 years and you're like, oh, that's a lot of time to make up.
One of the things we've said, Robbie and I, internally, that would define like our approach to investing to this point is we've kind of found, we think it does require an intersection of kind of passive philosophy and active implementation.
Yeah.
So it's not,
I like that. Oh, that's cool.
Yeah, it's not just we don't believe that the best way to do this is just buy the S&P and sit on it.
Yeah, it's not
We don't.
active versus passive. Say that
No.
again. It's a
passive philosophy with active implementation.
Freak. That's
so
nice.
That's the way we approach this with our internal money management, investment management. And so again, do we say buying the S&P and sitting on it for the next 30 years, that's better than trying to day trade accounts? 100%.
Please, yes.
But does that mean that just sitting on the S&P is the optimal way to do this? No, we don't believe that. There's other ways that we think are more optimal. The last part of this fix, I'd say, of myth number 2 is just please try to, as best you possibly can, ignore these financial media outlets, people telling you and trying to make you believe you can time things, talking about tactics of like, buy this stock now. Just try the best you can to ignore that kind of stuff.
Yep. Okay. So for the third myth of our 3 myths on this episode,
because we're doing part 1, 3 of 6.
You guys, look, we haven't strayed too far.
I don't feel like we have. I think we're just trying to pack in a lot of value.
There's more to say here than there was 10 years ago. Or we just don't have Justin sitting in the room forcing us to stick to the script. That's really what's going on. Myth number 3. I love this one. And it kind of speaks to what we just recorded about yesterday that'll come out soon. Myth number 3 is that maxing out my 401k means I'm saving enough. That's enough. Yeah, I've got a 401k. I'm maxing that out. I'm thinking, okay, a couple of things. Like part of me goes, all right, why did we put this in here? There's like conventional financial wisdom or advice, over the generations, like save 10%. That's been a huge one. Obviously. Save 10%, which I mean is still like twice the national savings rate average. So,
better than zero. Yeah.
If you did that, you'd be doubling the national average. Save 10% or just max out a retirement plan. Those great pieces of advice. I mean, everyone would be better off. Like every worker in this country would be better off if everyone had the chance to max out a retirement plan at work and get a match and do that for a 30-year career. I mean, it would be amazing, right? But for a dentist, it's just different. I mean, it's the principle why we built an entire company around dentists, because financial decisions in so many aspects are just different for dentists. It's just the way it is. So I think, this myth exists in here because it is conventional financial advice and wisdom, but it's not enough for a dentist.
Yeah.
If we did the math on, the average maximums of a 401k over a whole career, and maxing that out, it's just highly likely, unless that dentist is an anomaly and keeps their spending needs very below average for a dentist, that balance at the end is going to be enough for them to fully live the lifestyle they're used to. They just have to do a lot of cutting or hope that other assets along the way grew maybe disproportionately large. But that's why it is in here. So why is this in here? Traditional financial advice or conventional wisdom does not always apply to a dentist. And there's probably a few of them here. What stands out to you? Like, what do you think about when you hear this part of the myth?
I mean, I think you summed it up great. I truly don't have too much to add there. Is just the 401k, we think it's a great tool to use. I think it's a misconception, or you're selling yourself short as a dentist if you think that's all you need. It's a part of a much bigger plan that you should be looking at. And if we're talking specifically like saving for getting towards retirement, it's much broader. We need to look at your overall like cash flow and your actual savings rate. To your point, Ryan, because there's a limit on what you can put into a 401k, chances are that limit based on what a dentist on average spends and the lifestyle they've become accustomed to, a 401k in most cases is just not going to do it.
So here's
the only thing.
Totally, man. And I was just running some math here, just thinking about this. And I ran, and it is as hard as the 401k limits are changing. They used to be much lower, and they're getting higher.
Yeah.
So I try to put in like what's an average. It would be a very, very high average. I'd have to go find the data and find what is the real average of 401k over the last 30 years. What's the average limit in there? What would you think it even is? If you average the last 30 years of 401k limits, what do you think that average would even be? Under 20, right?
Yeah, because we just hit over 20 within the last
handful of years. I mean, would it
Yeah,
be
I
like, is
think.
18 too generous to say like 18,000
I was
an
gonna over
average?
the last 30 years, I was gonna say 15, yeah, but yeah, do like 17, 18.
Okay, I'm gonna go like let's go 17. Let's just be very generous here. But my thinking is still not even going to be okay. So I did 25 years of an average of $17,000 a year. Now there's a match in there too that's going to be helpful. At an 8% rate of return, you're going to get over $1 million in that over a 25-year career. That's a good size balance, and it's likely to be higher based on how you invest, the length of time, and match in there. It's likely to be higher. Here's the problem with my thinking though, is dentists typically do not start out with enough cash flow to max out a 401k day one of their careers. They don't start out with that. So typically dentist momentum, like financial momentum, is delayed. It's very heavy on the back end if they do
Back
things
end.
right, but
Yep.
it's like negative on the front end. There's a lot of catching up that has to be done in the back end, which is why plans that have limits, there's just not, you can't build up enough wealth in there because of the limits. Also, we just talked about this yesterday. Dentists need liquidity in their lives almost constantly. There's just a huge list of reasons why dentists need access to money throughout their whole career. You can't have all of your money be sitting in a 401k as a dentist. It'll bite you. It'll bite you in the
Totally
behind.
agree. Yep.
At some point where you need cash, you need access to money. And so dentists also need to be saving outside of their 401k. So those two things alone make my math, thinking out loud with my math, not realistic,
Yeah.
If you could day one at the beginning of a 25-year career, max out a 401k and get your match with the practice sale at the end, you'd probably have close enough.
Yeah.
But it's not reality. You can't do that. It's just not reality for the average dentist.
I like what you said earlier, and I think just is worth reiterating that this myth embodies, this is why I know why you guys put it in the original outline and talked about it, and I think it still holds true today, is this myth embodies how dentists are just different than the typical American.
Yeah, that's the old like American pension way. Like you get a job, you just get your pension, you just start it on day one, and then 40 years later on retirement, it's enough with Social Security and
or just like the typical American, like the average American, what they spend, what they make, what they save, like a 401k, if you're maxing out every year for a typical American, or you're putting money in and getting a match. And I think for the typical American, that actually works over 30.
It would over 30 years because the typical American needs far less money to live on average
less money
than a dentist.
But when you're spending on average 18 to 20 grand a month,
just to get by,
a 401k, it's just the math is not mathing.
It's not mathing. That. Yeah,
if you're spending $5,000 a month on average, or that's your typical lifestyle, great. Okay, then a 401k can do the job. Yeah. But for the typical dentist, it's just not. It's not going to work. You
and
need
it's kind of
more than that.
You do, and it's kind of like, I'm thinking about this spending now. Another topic, but it's kind of unfair to dentists. Like you think about so much of their spending is like loan and debt repayments, and it's for sure lifestyle. Regardless of where the spending goes, with or within their control, we get used to the money that leaves our bank accounts, no matter where it's going. Doesn't matter if it's taxes, mandatory debt payments, or just fund spending or utilities. We get used to the amount of money that has to go out every month. So when that drops off, it doesn't magically end back up in savings. Like we're just used to spending it. So the person who's used to spending 18 grand on average over a whole life of working career doesn't drop to $7,000 a month of spending.
No,
you just don't. You
don't do it.
Your brain's wired for 18. You figured out a way to spend 18. The fix to this, I loved what you put in your, might have been your Chatty G, but I like that you wrote this in here. The real driver is its savings rate. And you said it's a savings rate that's relative to your income because your spending is relative to your income. So
exactly.
$1 million earner is going to be spending more money typically on average than someone who's earning 300 grand.
Yeah.
So your savings rate has to be relative to income because your spending is too. I love that. Was great.
It's
great line, Matt.
Thank you.
Great line.
Thank you.
Yeah, it's good.
It's a percentage, right? That's why we do everything on cash flow based on percentage. Because the example you just gave, $1 million earner might be spending 250 grand a year, right? Which is even more than like the associate down the street makes, right? Yeah. But as a percentage of their income, it's actually really reasonable.
Pretty low. 250 on $1 million income? That'd be a low spending number.
It's a low spending number.
So you guys are killing it. Good job.
Exactly.
Yeah.
But same thing with savings. Like you need to focus on the broader number of like, what is my percentage of income going towards my future self?
Yeah, yeah.
And then the last thing we just said is like, okay, if a 401k doesn't do it, we got to layer accounts in. And you said it. putting precedent on liquidity right first and foremost. So like cash and then brokerage accounts, building those up, retirement plans, using Roth and other accounts. So the typical dentist, by the time they're mid-career and beyond, you're going to have multiple different accounts, multiple account types, and you should be putting money in all of them.
And you'll utilize them all along the way. Differently for what they're designed for, but you'll use them. Oh yeah.
Okay, Ryan, we got through 3 myths today.
Can you
Part
imagine
1
doing 3 more?
Yeah, I can.
We wouldn't do it justice. I know we wouldn't do it justice if we had to go 3 more right now.
I love how you started this off with the good old days, and you're like, yeah, we used to do 25-minute episodes.
Can't even imagine.
We're the worst. We've only gotten worse. We're not like a fine wine. We do not get better with age.
We do not age better. No, it doesn't taste better later on. It was better 10 years ago. Matt, thanks for going through that. And it was great. Back to these roots. It's fun to explore where we used to be 10 years ago, and just to see generally what's changed in the economy, what's changed in generational shifts in money, what's changed in technology, what's changed in, I was even thinking, I'm sure we're going to go there. We did an episode not too long ago where we revisited the standard 4% withdrawal rule, which had been updated at that time. And now you were just sending me stuff the other day that's like, that's outdated too.
Yeah.
Even
we're
some
do
of the
another
more,
one on that.
So good. So, all right, parting words, Matt, don't squash bees, like kill wasps, I would say, but like the honeybees, like if you can let them go.
I should have rephrased the very beginning.
Wasp.
It was a hornet.
Hornet.
It was a hornet. Yeah, not
like
a bee.
I don't F those guys.
Yeah, I don't kill honeybees. No, never.
No, they're great.
But a hornet,
they're fuzzy.
you're dead every time.
Every time. Why do you exist, hornet?
Dead. You're dead.
Yeah, dead to me. Okay.
I'll just say this: if this was helpful to you, and you think there's a dentist out there that needs to hear it, we'd love for you to share the episode. We want to share the good word and just kind of help, hopefully add value to the dental community. So we'd love for you to share the episode. And then what else, Ryan? What are the final words?
Well, I know some of you have questions. You want to chat about it. You want to run some scenarios by us. And luckily for you, you can do that. Dentistadvisors.com. We have free consultation appointments all week. And so find one that works for you. Let's have a chat. Tell us your story. We will always answer your questions, point you in the right direction, connect you with the right people, and just make sure that you're taken care of. That's what we'll do. Get on our calendar and let's have a chat. So let's do it.
Booyah.
Okay. Thanks for listening. Thanks, Manny. Appreciate it. Have a good weekend, everybody. Bye-bye.